Hi, my name is Yasmin and I hope you had an amazing day today. So in this video, me and my team, Damia and Haziq, will discuss the comparison of consolidation accounting to the equity method and talk over our opinions on the debate. So firstly, we will look into the key differences and similarities between consolidation accounting and equity method. So the general idea is that consolidating the financial statement involves combining the firm's income statement and balance sheets together to form one statement, while the equity method, on the other hand, does not combine the accounts in the statement, but it accounts the investment as an asset and account the income received from the subsidiary. So furthermore, in equity method, some items are implicit in the investment accounts, and this includes book value of net asset, goodwill, and also fair value adjustment. However, consolidation is the other way around. So firstly, goodwill is represented as an asset on the statement of financial position. And other than that, there are specific assets or liabilities on the consolidated statement of financial position that are adjusted to its fair value. So apart from that, there are also similarities between consolidation and equity methods. Firstly, when two businesses form a joint venture, they will have to use both methods where one company shares with another. And what's similar is that both methods have a higher level of influence and the company that dominates the ownership. So in conclusion, the differences between consolidation and equity method is mainly attributed to the way results of the investment company are incorporated into the financial statements of the parent. So accounting standards give the freedom to companies to follow whichever preferred method. However, the equity method is widely used, especially when the ownership is between 20 to 50%. So we will continue our discussion with Damia.
Thank you, Yasmin. Let's look at how managers can privately benefit from choosing the equity method over consolidation when the determination of control and significant influence is unclear. Firstly, it provides managers incentives to maintain technical eligibility for the equity method rather than full consolidation. The equity method has been criticized because it allows the investor to recognize income that may not be received in any usable form during the foreseeable future. Income is being accrued based on the investee's reported earnings, not on the investor's share of investee dividends. Frequently, equity income will exceed the investor's share of investee cash dividends with no assurance that the difference will ever be forthcoming. Many companies have contractual provisions, for example, debt covenants, manager compensation contracts, and these are based on ratios in the main body of the financial statements. Relative to consolidation, a firm employing the equity method will report smaller values for assets and liabilities, and this results in higher rates of return for its assets and sales, as well as lower debt to equity ratios. Additionally, the second benefit is managers are avoided being affected by reported income in a way that does not reflect actual performance. This can be seen if dividends were recorded as income. The equity method is appropriate when an investor has the ability to exercise significant influence over the operating and financial decisions of an investee, because dividends represent financing decisions. The investor may have the ability to influence the timing of the dividend. Therefore, in reflecting the close relationship between the investor and investee, the equity method employs accrual accounting to record income as it is earned by the investee. The investment account is increased for the investee's earned income and decreased as the income is distributed. From the investor's view, the decrease in the investment asset is offset by an increase in the asset cash. Next, we have Haziq who will be sharing about conjecture several mechanisms or solutions that could be implemented to mitigate the potential manipulation.
Thank you, Damia. Today, I will share some of the solutions that may be used to lessen the possibility of manipulation in equity investment. There will be two methods that we recommend to control this manipulation, which are being hiring an external auditor and implementing a reconciliation process. Let me explain. Firstly, an external auditor is a public auditor who does audit and review the company financial statement. An external auditor is neutral since they are not affiliated with anyone inside of the company, making them well suited to evaluate financial report and internal control framework. Therefore, an auditing process should be done annually by the company since it will highlight the problem with financial management every year. Moreover, the data outcome for the external auditor will be shared with shareholder, the company, and the public. See it follow the auditing standard and has a fair perspective. The data from the external auditor get recognized as true. Meanwhile, hiring only internal auditor only focus on providing a perspective on the effectiveness of the operational activity of the organization and to fulfill the board interest. Therefore, there will be the bias in the report. In addition, the equity method is known as a method that managers use to avoid being affected by reported income in a way that does not reflect actual performance. Therefore, hiring external auditor to check the accuracy of financial data is the best method to lessen the likelihood of manipulation. Secondly, at the end of accounting period, accountants should apply account reconciliation to ensure that general ledger account balance are accurately reported. Reconciliation is the process of comparing internal record of transaction with monthly statement from outside sources, such as bank statement. This process is required to determine if the payment and deposit transaction are the same in both records from the internal filings with the bank statement. Reconciling the account is important because it helps detect any mistake, manipulation, or fraud in the accounting report that could severely impact the financial health of the company. Moreover, the equity method is famously known as very challenging to apply and comprehend. The process of obtaining, comparing, and reviewing statistics between the parent business and its subsidiary takes a long time. Therefore, using this method will help identify error record and suspicious cash flow by comparing the differences between the accounting record cash balance and the bank statement. Any manipulation done in the account report will definitely be detected. Now, back to Yasmin.
Thank you, Haziq. So next we will discuss whether it is more desirable to require uniform accounting treatment for equity investment, regardless of the level of influence the investor holds on the investee. So generally, the extent investor control over the investee's operational or financial choices is the main factor to be taken into account when using equity accounting. So a corporation can exercise influence over financial and operational choices when another company, or largely known as the parent company, makes a significant investment in the corporation. But interestingly, not so new norm is that majority ownership of the investee by another party does not necessarily limit the investee's capability in making decisions. A situation named as minority active interest exists when the investor holds 20 to 50% of the company's shares. And this gives the investor the ability to influence management decisions, but not to control the investee entirely. For instance, we have Robert W. Byatt and Co., which is an established company in the world of finance that invests the companies at various level of growth, including those in idea phase and all the way up to those companies with 150 million in revenues. So this way, the parent company can focus more on strategies rather than the operation issues so they can grow the BR business more efficiently. Moving on, Haziq will continue our discussion.
Thank you, Yasmin. Firstly, to produce more accurate and comparable report of company financial activity, Uniform Adjusted Financial Reporting Standard, or famously known UAFRS, can take as example set of criteria for examining and analyzing financial statement. This uniform accounting adjusts the reported financial statement to create as consistent a report of financial activity as possible, free of distortion from changing or ecosystem financial reporting policy from year to year across the firm. This will result in a consistent accounting approach that make it possible to compare statement and information, make it simpler to see pattern and extract reliable data. Next, Damia will continue to explain more about the benefit of having uniform accounting.
Thank you, Haziq. Now that we have seen the types of equity investments and the first advantage of requiring uniform accounting treatment for equity investments, I'll now discuss the other advantages, where uniform accounting treatment provides a liquidity benefit by easing interpretation of the standard among investors. This draws more investors into the capital market and increases the supply of market and decreases the equity cost of capital. This allows investors to compare investment opportunities across the economy more easily because all financial reports are expressed in the same language. Furthermore, it is more desirable to require this treatment for accounting investments because it saves investors from having to learn multiple accounting standards, which are multiple languages in the capital marketplace. These trade-off between costs and benefits in the uniform treatment results in lower compliance costs among firms because it allows the regulator to more finely pick the accounting standard and reduce the deadweight loss from compliance. Lastly, the application of the equity method provides more informative reporting of the investor's net asset and profit and loss. Recognition of income on the basis of distributions received may not be an adequate measure of the income earned by an investor or on investment in an associate or joint venture because the distributions received may bear little relation to the performance of the associate or joint venture. For example, if an investor has significant influence over the investee, the investor has an interest in the associate or joint venture's performance, and as a result, the return on its investment. The investor accounts for this interest by extending the scope of its financial statements to include its share of the profit or loss of such an investee. As for the conclusion, our group believes it is more preferable to enforce uniform accounting treatment for equity investments. With that, we would like to sum up our presentation and thank you for listening.